Hey, in this video, I'm going to talk about variable life insurance and variable universal life insurance. Variable life insurance is a type of security. Here, you have to know it's a security. So when it's variable life insurance, so they are both insurance and security. Security is like investment products, bonds, stocks, bonds, mutual funds, ETF, those things called security. So variable life insurance are security. So they offer fixed premium. So premium is fixed. Then minimum death benefit. You can see the death benefit, they only guarantee the minimum, can be higher. So we'll talk about later. Unlike the whole life insurance, its cash value is invested in a portfolio of securities called a separate account. As the policyholder, you can choose the mixed investment from those policy offer. However, the policy's investment return is not guaranteed, and the cash value will fluctuate. So you can see, so portion of your premium will go into called a separate account. So now, because it's a variable, so you assume the investment risk by give you the flexibility. You can choose the investment products within they give to you a list of the mutual funds selection. They say, you know what, you can go to select those investment products. You assume the risk if the investment not doing well, so you will have a lower death benefit, lower cash value. So that's make it this life insurance variable as a security. So you bear the risk rather than insurance company. So the premium are typically higher than the variable life on a variable life policy than a equal amount of the whole life. So basically say if you buy $1 million policy, if you bought as a whole life policy, so your premium is much lower than the $1 million variable life insurance. So one of the reasons because they give these variable options, so make the product is more complex. So complex product requires higher, administrative cost, right? So also this is security. Security you requires federal regulation. So you have to register with SEC. So you have to comply with all the federal laws. So that incur another layer of the cost. So those type of products is more expensive than the traditional life insurance policies. So because it's a security, there's a prospectus. So when you buy a mutual funds, so they give you a prospectus. So because variable life insurance is a prospectus, so it's a security, so there's prospectus required with the products you purchase. So they you can find all kinds of information in the prospectus. So you can see they have to allocate all those resources to produce those prospectus that will increase their cost of their product as well. So the buyer of the variable life insurance must be willing to give up the guarantee of the cash value in exchange for the possibility of the enhanced death benefit and the cash value. So basically say, well, you invest yourself in the separate account. If your investment doing well, you may have a higher death benefit, you may have a higher cash value. For that's all based on the investment, right? So to summarize, say a variable life insurance is both insurance and a security product. So they is variable life insurance require you pay fixed premium for the life of the contract, right? Then they guarantee a minimum death benefit. They guarantee some of the benefit, but it's not all. So then not guaranteed a cash value because you invest your cash value yourself. So based on the investment performance, right? So they do not guarantee the cash value. That's something you need to know about the variable life insurance. Now look at the variable universal life insurance. So variable universal life is basically married with the flexibility of the universal life with the investment selection of the variable life. We just talk about the variable life is you can select the investment yourself. That's make it variable, right? You bear the investment risk. There's no cash value guaranteed. So then you, because you can see variable life insurance require you pay fixed premium. Then we knowing that universal life insurance allow you to pay premium flexibly. So this is variable universal life. They have the same option as well. When you have more money, you can pay more into that premium, right? You pay a higher premium if you have more money. If you have less money, you have a cash flow problem, so then you can stop paying the premium for a while. So that's have the flexibility in the premium payment. That's make it a variable life insurance. So unlike the variable universal life guarantees only the mortality rate and the rights to keep the policy in force by paying whatever premiums are required to do so should the cash value declines. They basically tell you, well, they may only guarantee the mortality rate, then they guarantee nothing else. They guarantee no death benefit. They guarantee no cash value. So they guarantee nothing. So basically, that's variable universal life. Then this type of products requires that owner be familiar with the investing and willing to bear the expense and the risk of this type of policy. So you pick the investment yourself. So that's why you should know the investing. Then the variable universal life policy are complex and they can be very expensive. They can be. So essentially, all the risk other than the mortality risk is assumed by the policy owner. So you can see this. To summarize, variable universal life is insurance and security products. They do have one positive thing is flexible premium that not guarantee you death benefit, not guarantee you cash value. That's something you need to know. So here there's a little comparison here that illustrates how $1,000 premium is applied to variable life policy and the variable universal life policy. So here they tell you they do not take the consideration of the policy cost, assume there's no rider, right? So you just have to remember when you really buy the policy, everything else will make it even more complex. The provision, the rider, all those things will make it even more complex. So now we don't consider all those things. We just purely compare, the universal life and the variable life and the variable universal life. Let's see, you put the $1,000 annual premium in for variable life. So $400 gonna apply to the death benefit. Then $600 gonna allocate it to the separate account. So you can see that's why they guarantee you a minimum death benefit. So you can see here, because they put some of the premium to build your death benefit. So then the $600 they into the sub account. You know that sub account have the investment option. You choose the investment option. You bear the investment risk. So if the sub account investment doing well, your cash value may higher, right? Then your death benefit may higher. So that's something. But if the investment, investment doesn't do well, so you will end up have a lower death benefit, lower cash value. So then you can see 1,000 annual premium if you place into the variable universal life. So variable universal life, you can see here, they place the entire thing into the sub account. So they will deduct very high monthly mortality and expense charges. They will reduce your premium by those charges. If the sub account decrease in the value to the point not sufficient to support the charges, the policy will lapse. Because their cost is so high, sometimes your cash value and the premium may not cover all the charges. Then they may require you to pay more premium. If you can't, you will give up this policy. So that's make it very risky. So basically say, well, you can see here for variable life, you have some death benefit guaranteed, right? Then you compare variable universal life, there's no death benefit guaranteed. Then no cash value guaranteed. So basically, just say if you're lucky, you choose the great investment, the investment doing so well, then you will get higher death benefit, get a higher cash value. However, whatever your investment doing, we're gonna take our fees, our expense.